much, Marty. And also just want to say what a great panel that was on real estate by Elizabeth and the panelists. So that was a good conversation. Good afternoon, everyone. Thanks for joining our discussion titled Family Office Investing and Direct Deal Making in 2021. I'd like to also thank Marty Sakata and his team at Ivy Family Office Network for organizing today's event and bringing together such esteemed panelists for today's discussion. We have a wide range of topics to cover, and our speakers will share their perspective on the investing landscape across different sectors and geography, from US to Europe to the Far East. They will share their sentiments on the area of opportunity they're excited about, as well as some of the emerging issues that might keep them up at night. And that's not including the late night Summer Olympic game that just ended in Tokyo. So let's get started. First of all, let me introduce myself. My name is Asvakovith. I'm the co-founder and CEO of Piedmont Fund Services. We are an independent fund administration firm. We've been around for about 16 years now. We are headquartered here in Washington, DC metro area, and we have offices in New York, Kuala Lumpur, and Manila. We work exclusively with alternative investment fund managers, such as hedge fund, private equity, venture capital funds, as well as asset owners, such as foundation, endowments, also CIOs and family offices. We also develop and license our proprietary technology portal to our clients. So some would also classify us in the fintech space. So prior to co-founding Piedmont with my partners, I used to work at Ernst & Young in New York in their asset management division. And now I'd like to ask each of our panelists to introduce themselves and their organization so that you can get to know them a little bit. Mauro, since you're tuning in all the way from the other side of the pond, maybe I'll let you go first.
Thank you. So my name is Mauro Andriotto. I'm a professor in finance at Bocconi University in Milan, in Italy, and at the University of Pisa. I'm based in Switzerland. I teach also with the University of Geneva. I am a European Commissioner. I help the European Commission to select projects that will be financed within the new program, the new 100 billion program for financing innovation, startups, and small medium enterprises that it's called Horizon Europe, and in particular the European Innovation Council. I am the former quantitative leader of Ernst & Young for the South Europe, and currently I am an equity partner of SMC, that is a Swiss family office with 15 physical locations in many different countries, in particular in Russia, Middle East, Switzerland, Europe, and South America. I'm also an equity partner of an asset management firm that is a new company with around 100 million under management. It's based in Lugano, and we manage different funds, particularly in real estate, classic cars, gold, and a fund that is based on blockchain.
All right, great. Thank you. Thanks for that introduction. Manpreet, would you mind going next?
Hi, I'm Manpreet Singh from the DC area. Spent most of my career in finance and technology. Was employed a fund in investments. We grew the fund 100x in AUM over 10 years, mostly in public equities. Started looking at private companies in 2009. I was fortunate to source the firm into Alibaba back then at a couple of bucks a share. And we did a dozen or so other marketplace and SaaS deals, including companies like Bazaar Voice and Social Tables and Mindbody and Marqeta. I ended up officially leaving the fund in 2012, started a tech company that was seeded by some of the most senior guys at the Carlyle Group. I built a marketplace business and local services. I ran that business till 2018, and then 2018 launched SAP, which is a multifamily office to help manage my family's capital and a handful of wealthy Sikh families. Many of these Sikh families that support us are run public companies in the US. So I'm sure you might know who they are. And we're very active in growth equity, early stage venture capital, and real estate. We also look to acquire operating businesses, such as we bought one of the largest home inspection companies in the US. And we've also bought a handful of software businesses.
Awesome, thank you. I see Pat just joined us. Pat, go ahead. Would you mind introduce yourself, please?
Sure. Patrick Flynn. I've spoken on a couple of these before. So for those of you who don't know, though, I work for Manhattan West, which is a multifamily office based in LA. We have about $1 billion, $1.5 billion under management. and we do a couple different things. We spun out of JP Morgan about 5 years ago, started with really just equity exposure and bond exposure, organically developed a real estate team where we invest, and we have about $200 or $300 million. And then on the venture capital side, developed a direct and fund investment platform that we have for our families, and then more recently have developed about a buyout team. And I work on the venture direct investment and co-investment side. So I help a lot of our families get access to early stage, late stage, private equity names, buyout names for them to invest in. And personally, was a banker, then a trader, and have been working in the family office industry for like the last 8 years or so.
Okay, great. Simon on the panel today?
I think Simon mentioned that he was going to be running a little bit late.
Okay, so we'll have Simon come on and introduce himself in a bit. Maybe first, let's go back in time. I think we can learn from history, right? Let's start a conversation by going back to the beginning of the pandemic around March and April of 2020. When you look back, what lesson did you draw from this unprecedented event, and what adjustment, if any, have you applied to your investment portfolio back in early 2020? Anyone want to start off? Manpreet, you want to go ahead?
Yeah. So I would tell you, we have a couple of operating businesses. So we want to be very aggressive, right? So I think we were kind of sitting on cash and waiting for a downturn. And so when the downturn came, we actually hopped up. We spent a lot of time on public equity. So our focus from private and other asset classes switched almost immediately.
Yep.
And so for like a good 30 to 60 days, we were just looking at public equities. We also were spending time on some of our portfolio companies that were having issues. One of them is a large inspection company, and so you couldn't go out and do inspections, right? So that's not good. We did try to use that opportunity to try and buy some other guys. So we did kind of make a number of calls. And then the other things we did take advantage of is we ended up doing a number of like growth equity investments at the time. So there were probably like 6 or 7 companies that were on our list of companies we liked that we thought were a little expensive the last maybe 1 or 2 times we looked at them. And we basically made calls and said, hey, are you guys looking to raise more money? Because what's happening? And if so, what valuation would you guys do? And most of them were raising at the same round they might have done like 6 months or 12 months before that. And so even though the business had progressed nicely, the valuation remained the same. And so we stepped in and bought a bunch of shares of some were secondary shares, some were primary shares, some did primary rounds, and we were very involved with a lot of those.
Okay, that's when patience pay off. You've been waiting, you have cash ready.
On the real estate side, we were actually very direct. We did make a handful of offers on residential properties, on commercial properties and strip centers, and we actually won some things. So we ended up tying up a bunch of things in April and May. We had like a 6-month time to close. So we didn't end up closing until things kind of calmed down.
Got it. Okay. How about you, Pat, from your perspective? What happened back in March, April 2020 when you look back, and what have you done during the time?
Yeah, I think for us, hospitality would have been a nice thing to get some things on discount. But I think from a venture perspective, I think that there was an ability to access some names and some opportunities that I think were really unique and really interesting. And having cash on the sidelines was really important. Like, I remember Robinhood was at like a $5 or $10 billion valuation or something like that.
6, 7, 6. Yeah, I remember we saw it.
Yeah, it was insane, and now we're there at 40 billion in less than a year, right? So I think the ability, the tough thing, in when you sit in the seat that I do and that the other gentlemen here do is, you have to the quickest opportunities are usually the best. And so having fresh powder to deploy capital is incredibly important, and having a system in place to make those decisions is really important. So when I think about those, though, it mostly is, kicking myself because, I didn't we got into the ribbit round for Robinhood, but we didn't get into, when I could have gotten in at the $5 or $10 billion range. Right. So anyway, so I think personally, it's probably missing those, but I think as a firm, we really felt like we missed the boat on, we didn't do a great job on the equity side. We could have done better, I guess is the answer. And then on the real estate side, we probably should have gone after some hospitality type plays and maybe done some transformations and made them, maybe some multifamily or done a full value add piece on some less, some hospitality that needed maybe a revamp or something like that. So
was the window very short of opportunity? Was it like just a month or two and things start to really pick up?
I think there was a big group. The biggest thing was there was a couple months where you were getting things that were really, really cheap. And the reason why was because people had missed on payments or they had commitments that they had made and couldn't actually be able to do. And so we actually, one of the things I called a lot of the people that I'm close with and that I do a lot of investments with. And I basically was like, hey, if there's anything unique and there's some kind of unique situation where somebody needs liquidity or somebody needs some kind of, there's a certain reason why you need capital quick and we can get it at a discount, we'll be your capital partner, right? We'll make that work. And so we've been really fortunate to be able to capitalize on those opportunities and, in essence, like save somebody, right? And get somebody out of some trouble. And then also, do a great job for our families. So we feel like we're in a really good place.
Got it. Okay. Mauro, how about you from the European perspective? How was it back in 2020 and what have you done during that period?
Well, yes, so we have had some projects at the beginning of 2020 that have been stopped because of the pandemic, and both of them were in the tourism and hospitality sector. Even if they were not based in Europe, one was in Russia and the other one was in South America, in Brazil particularly, that was hit also by the political problems. So both of them have been actually are on hold. I would say that on the development side of the real estate, the crisis clearly had a strong effect because many of these projects have been stopped. But on the other side, we have seen some really good opportunities in restructuring. Right now, we have a big restructuring project in the north of Italy that we are working on, and it's about hotels and lands that can be used for hospitality and tourism projects. I have to say that also there are some really great opportunity with the European Commission according to the plan to Horizon Europe, a program that has been recently launched at the beginning of 2021. It's a 100 billion program and it's open to any company in the world, so also company from US, Asia, and everywhere in the world. It's a program that is financing innovation and new companies that are going to be incorporated in Europe and that they can receive the funding from the European Commission. As you probably know, in Europe, we are missing Silicon Valley. So we are missing venture capitals that are investing in the seed stage of the companies. So the European Commission is trying to recreate, let's say, a kind of a public Silicon Valley, even if this is attracting a lot of investments from the private side, because there is already a track record about this program. In the last 7 years, 37% of the companies that received the funding got listed in one stock exchange around the world, and another 40% made private equity exit. So clearly there is a strong interest from venture capital when to co-invest with the European Commission according to this program. And to come back to the initial question, the two main areas where there are now this type of opportunity with the European Commission are about, one, it's about climate change. That was also before the pandemic, but the other one got a boost with the pandemic, and it's everything that is related to the digital world, where also the European Commission is investing a lot after the pandemic.
Okay, well, hold that thoughts. I think we'll try to see if we can maybe come back to that. It sounds like the European Commission is trying to compete against a SoftBank on the largest fund, $100 billion. So maybe we'll come back to that and see how audience and other investor can take advantage of that. Now let's switch gear to United States. Here in the U.S., things seem to have bounced back from the low. Unemployment is moving toward the pre-pandemic level. The new jobs number come out today. We're getting there. Equity indices are at an all-time high, right? But yet the new variant from COVID-19 and the risk from that is still looming. So as an investor, how are you guys positioning your asset allocation in the current market situation? How often do you have to revisit and adjust those allocation? Maybe Pat and Manpreet, you guys can maybe talk about this.
Manpreet, you want to go first? I'm happy to if you want.
You can go first. Yeah.
Yeah. So I think from our perspective, and it's something I've talked about with a couple of people on actually this panel before is, and we're trying to invest in like portfolio allocation is pretty critical for us. But I think the most important thing for us is actually like investment thesis and long-term investment thesis. And I hope that makes sense. And if it doesn't, feel free. I'm happy to expand. But essentially, like if we like, I was talking to one of the people who are his colleague yesterday, and we were talking about the risks of investing. We're investing in Possible and in Just, which is another alternative food company, and what the risks are of investing in both of them. But I think if our investment thesis for alternative foods is long term, we think is going to play out. Our concern shouldn't be that that's going to go down. It should be that we have conviction in that type of thesis and feel comfortable with it. So, but I think from the portfolio allocation perspective, we're trying to get away from trying to investing in companies that we want some diversification across different industries is really the only answer. It's like simple answer I can give you, and across different asset classes. And as long as we can adequately keep our families diversified, to me, and mitigate risk by being invested in the private markets in both real estate and private equity and also in bonds and stocks, we're going to be able to do that. So like our long-term goals don't change. There's some small changes, but nothing that would be significant. I hope that answers your question.
Yeah, it does. Now with the valuation where it is, do you tend to stay on the sideline deals that doesn't make sense and try to maybe build up cash position in case there's any downturn that might be coming up?
Yeah, so we're going to try to stay away from there's where I sit, companies that are like there's been some crazy valuations all over the place. I think as you mentioned, right? But and staying away from things that are trading at ridiculous multiples and that are pre-revenue and fetching more than $1 billion valuation. So basically on an idea is crazy to me, right? So I think we have to let those sort of play out more. But yeah, I think from a valuation perspective, it's really tough to look at some of the companies these days and see and be like, oh, this is an awesome investment. There's a ton of meat on this bone, right? And so we constantly check ourselves on. I think I gave you guys the example of Airtable when we spoke. Like things trading at 75x its revenue, right? That's an insane number to think about, right? Like 75 times its revenue is how much the valuation is, and I think it did like $200 million in revenue, right? So, like, there's no reason why a company should be fetching that kind of valuation. But there's public comps to make it work, right? You can it makes sense if you want to make it make sense. So we are constantly checking ourselves with, basically like the bottoms of markets and seeing where those traded and from a risk perspective, understanding where the valuations have been and will be, and we think are right now. Got it. Okay. How about you, Manpreet? What do you see on your side?
Yeah, I would definitely agree with a lot of what he said, and especially when it comes to these valuations. When I started investing in private companies, 12 or 13 years ago, we were investing at 3 times sales, right? So Sales was even less of a measure, more of like, projected EBITDA a year or two, not, 5, 6, 7 years out. What we've done is we've started to go a little bit earlier, right? Instead of doing the pre-IPO stuff, we've started to do more A's and B's and C's. We've just found more value there. And I guess because the bigger money kind of comes in after, you end up seeing a quicker markup. I'm not sure how long that market will last or the company will be successful, but it's nice to see the markup, yes, because of some of these things are happening. We are spending a lot more time, I guess, in seed and Series A, seed as well. So we weren't doing as much seed before. We are starting to do a lot more seed because we think we can actually help the companies grow and even win some contracts, which I think is awesome. I think on the hotel stuff, I think on hospitality, you guys mentioned we had made a number of bids on hospitality assets, but we got outbid, and in some cases almost 2 times what we were willing to pay for the properties.
Wow.
So I think the money is still cheap and out there, right? So that was, I think we were shocked when we saw that. And just to give you an idea, one of the properties we bid on, this is like June of last year, just to give you an idea, like May or June of last year. That property, we were going to pay like 12 or 13 million. I think it went for like 22 or 23 million. And prior to the pandemic, that property was listed on the market for like 18 million. So we never expected to go for more than 15 or 16 million, right? So I don't know what changed.
Yeah.
Nothing. It's the answer.
Yeah.
And I had a quick question too. So, and quick comment too. I think something also we've developed the early stage side of things too. We feel like it's the later stage side. And granted, I don't do as much of that. I'm more Series C, Series B, Series C and up. But I think you're absolutely right in the sense that the early stage is like before that, the SoftBank or Andreessens come in, is where you're going to see the most bang for your buck. So I just wanted to, we completely agree with that thesis as well.
Yeah, for sure.
Hey, on that hotel deal, just to follow up, what sort of cap rate are you looking? What was the cap rate on that deal? Was it like, because there can't be any cash flow back in June 2020, so I'm assuming they're just looking at from the comps.
Yeah, so at the peak, that building probably did like a few years before that, it probably did like 3 million of NOI at the peak of the day, 3 or 4 years, maybe 2015, 2016, and around that time it was I think it was breaking or losing money, but we thought that time it was losing money, right? But we thought it could kind of get to between 1 and 1.5 of NOI. There was a very unique part of it. There was a $600,000 NOI that was coming just from the parking lot. And so we thought we could separate that as that piece. It was basically released to the city, the parking lot, right? So that was almost guaranteed. And then there was a separate building there's 2 hotels on the property, 2 separate buildings. You could essentially piecemeal the second property and do short-term rentals and mid-term rentals with it. And make quite maybe 400,000 or 500,000 just off that separate, right? And you could make $1 million off. So we thought it could be like a 2.5 million type of NOI property, and so we were willing to pay like I don't know 5, 6, 7, maybe 8, 7, 8, that kind of thing. It's kind of where our head was. The developer actually came in and bought it, so it was a very prime piece of land. And I think they thought we had a thought like, hey, could you just destroy everything and start fresh and build multifamily here? And that's what the guy is doing now, right? So
that's probably what he did, right? Yeah,
probably worth it.
Apartment.
He's probably doing great on it. Yeah.
It was next to it was in Baltimore, so it's actually next to the Oriole Stadium and the Ravens Stadium, so it was a prime location.
Got it. Okay. And when you say that you moved up earlier in the life cycle of the business from, say, IPO to like the Series A, Series B, is your evaluation process a little bit different? When you go up earlier, the company a lot less mature, and you have to look at different things.
Yeah. So I think we and the A's and B's we've done, we've been sensitive. We've been trying to go after certain things. So we've been going after companies where either the founder didn't want a ton of dilution, so maybe they might have seen a term sheet that was for 50, 100, 150 million dollars, but the founder was smart and said, look, I only want 10 million, I only want 20 million or 30 million. And so we were able to kind of come in there with a better valuation. We were putting in a lot less money, right? Like the fact they could deal with like one party or 2 parties. I guess the research, we're still looking for I think we're looking maybe for stronger unit economics at the earlier stages versus like the deep tech AI stuff that may not have unit economics. It's more of like a bet on the team. So we've kind of avoided some of those things at those stages. And then the seed is just like a lottery ticket. I mean, we try to have our LPs and friends who are very well connected or run public companies to like due diligence on some of these opportunities. And it definitely helps. Like, hey, you can win like 3 or 4 pilot customers, but it's still really early, right? So you're kind of really just betting on the team at that stage. We've also gone later stage. So example is that we've actually been involved with a number of SPACs. So we started launching SPACs in 2019, way before the kind of the current wave. And so we've already taken some of our companies public through SPACs, right? So we have a couple more SPACs kind of coming out.
Got it. Okay. Mauro, how about you? From the other side, from the European perspective, are there anything that look interesting in any particular sector or opportunities that sort of emerging as a winner out of this pandemic?
Well, an interesting strategy for us is, as I said, to co-invest with the European Commission, because the previous track record of this program, I put the official link of the European Commission here on the chat. That was called as ME instrument, had an amazing results. So as I said, 37% got listed, another 40% made a huge exit with the private equity. So it means that more or less almost 80% of the companies have been successful during this program. So the reason is that companies can get up to 17.5 million from the European Commission, of which 2.5 million as a non-refundable, non-repayable grant, and 15 million as an investment from the European investment funds. The real key of this success is about having the European Commission as one of your shareholders, because once they decide to invest in your project, clearly they will do everything that is in their power to help and to make that project successful. So it means that you will have the entire network of the European institution where you will have an easy access, and clearly you will have also access to any type of corporation and multinational around the world, because at that point you are going to be presented by the European Commission. And I think this is the real key. So in Europe, there are a lot of venture capitals that are looking at projects that are co-invested with the European Commission, because clearly it's a matter of statistic. And if you look at the previous number that are public, you can see that there is this really amazing track record. On the other side, the projects that we are looking with interest are about restructuring. As I said, the real estate, it's one of them. Real estate linked with the hospitality, it's particularly interesting right now. There have been a lot of structures in Italy that are or were close to bankruptcy, and you can find quite a lot of opportunities in that area.
Mm-hmm. And do you see any U.S. investor getting involved in some of those transactions, or still primarily European investors?
Yeah, we are speaking with a couple of U.S. fund in order to. We are looking at a possibility of co-invest with a couple of U.S. fund. So yeah, there is. I see some activity. At least in Italy, you have 3 areas that are interesting also for international investor. One is fashion, another one is food and beverage, and the last one is tourism and hospitality.
Mm-hmm. Mm-hmm. Okay. Well, I was going to ask you later about the EU innovation program, but since you brought up now, maybe we can kind of go in a little bit, because I think some of the audience here may not realize that this program is not just for European domicile company. you can be located in other parts of the world right now, and you can actually apply for this program, but you may have to relocate there if you get the grant. Can you just talk a little bit more about that?
Yeah, it's not very difficult to participate. We also help our clients when they want to try to present the project to the European Commission. You need to have an innovation. You need to present a business plan with a particularly template, but the content it's very similar to a classic business plan. There are two phases. Phase one, you need to prepare a small business plan, a video, and a pitch deck of the project. And in phase two is a deeper business plan with an interview with the jury members of the European Commission, which I'm a part of. And clearly, just to be clear about this, I do not. I always when I prepare a proposal, I do not evaluate it, and when I evaluate a proposal, it means that clearly I haven't prepared as a consultant. It takes from 4 to 6 months to receive the money, and if you win, you get. If you are selected, you get immediately 40% of the grant. And then after a couple of months, you can get the remaining part of the grant and of the equity investment by the European Commission. The total funding, as I said, for every company is up to 17.5 million. The grant is covering all of the development phase, while the equity is covering the go-to-market phase. European Commission use a scale that is called technology readiness level. That is a scale that they took from the NASA in order to understand what is the stage of development of a project. And in my opinion, if I would have an innovation, I think this would be the first channel where to present my innovation, because the probability of being funded, the statistics says that you have from 5 to 10% of being funded. So I really would like to participate in a lottery where I have from 5 to 10% probability of getting 17.5 million. I would play at least twice a day in that lottery.
Yeah, anyone would, right?
Yeah.
Okay. Is there a requirement that, okay, there's a number of jobs you have to create, or as long as you relocate and you have your operation in Europe, that meets a requirement?
Yeah, you need to have an innovation with a strong focus on the market and on the growth, on the business. So the final goal of the European Commission is to create a unicorns in Europe. Clearly, there are some challenges that the European Commission has, like, for example, climate change, security of people, food safety, and so on. There are around 10 challenges. So you need to present an innovation that it is compliant with a sustainable growth. But there is no any particular limits when you present your project. You just need to be at a TRL 5 or 6. So it means that you cannot have just an idea. You need to have a prototype or a strong plan that you can present to the European Commission. But there is no any other limitation about sector or country, because as I said, if you are going to be selected, you can be you can be based outside Europe. If you are going to be selected, you just need to create and incorporate a subsidiary in Europe that will receive the funding and will develop the project.
Okay.
Can I just jump in here 1 second real quick? So there are many countries right now which have lift out programs for American companies who want to, reposition themselves. So South Korea has a program, Canada, Toronto has a program, and there's a dozen European countries. There's so many programs now. There are people who are specialists, and all they do is help people set up, post office boxes and WeWorks offices in Germany or places like that. It's almost becoming like Bermuda is, or one of these other countries is for hedge funds. So it's very interesting how is going right now. But there is, capital, as Mauro brought up, for people who are looking to, get into relationships with other countries.
That's a very good point. Thanks, Marty. All right, I'm going to switch gear back to the U.S. and let's talk a little bit about real estate. Just following on that last panel, that they discussed about real estate. Manpreet, I think you guys focused a bit in this area. This is an area that within the subsector of real estate, there are some hard hit since some of the businesses either have shut down or they moved away from physical space to do the business. So where are you seeing opportunities right now from your perspective within the real estate sector?
We've been looking. We're bidding on some assets right now in the industrial space. It's actually been quite hard. I would say that people's expectations on cap rates on those assets have come down, and so we probably are going to end up winning this property for paying maybe 3 or 4% more than we probably wanted to pay. I think part of it is we have quite a bit of 1031 money we're working with, and so we have to deploy. In terms of the other real estate stuff we're doing, we do a lot of multifamily, and where we buy and turn these properties into short-term and mid-term rentals. And so we are doing a lot of that in Barcelona and Paris, actually. So that's a big part of our portfolio. And there we are seeing a lot of availability for deals and rent properties, given the tourist volume has come down and it's not really back to where it was before.
You said that those multifamily location, where are they?
Barcelona and Paris. Barcelona and Paris.
Okay, Barcelona and Paris. And how are those markets compared to, let's say, in the United States? Are they very strong performance in terms of rent increase?
Yeah. So what we like about them is we can usually buy the best deals tend to be like these 3, 4, 5, 6 bedroom properties, like the larger ones, because they're usually rented on like maybe on a long-term basis and the yields are not as high. We can come into corporate or short-term and we generate significantly higher yields on them. So that's why we like them. We have 100 now in that area. And
oh, wow. Okay. How's the tenants law and all that compared to, say?
Yeah, we only buy licensed properties. So that's why versus the US, in the US, there's a lot of folks that are doing short-term rentals. There's a lot of gray area, I'd say. And there we actually buy licensed properties. So we are benefiting from the legal system is like pushing properties that are unlicensed off of Airbnb, the different platforms. And so the value of our properties continue to go up over time.
Got it. Okay. Pat, did you guys do anything in the real estate side at all? Your firm?
Yeah, I don't personally. I know that we also have seen the industrial cap rates, also things getting a little bit like we can't catch a bid on anything industrial in the Southern California. We only own in Southern California. So, and we only do multifamily and industrial. And yeah, it's been definitely a grind. The thing, I think the thing for us, as I've talked to Adam, who runs our real estate team, is that we really want to make sure we're playing in the space between, the Blackstones of the world and then the mom and pops of the world. And so that tends to be like a $5 to $20 million properties. So that becomes, and there's only a limited amount of those. And then I think there's a lot of people who are dipping down into that space to try to find some returns. So yeah, we definitely play in the space. I'm not as fluent as I am in the private equity space, but it's certainly something that we look into for sure.
Sure. Got it. Okay. Now for some of the family offices out there that, in the past, they have worked with external managers, but over the years, they're starting to see opportunities. They want to consider bringing that in-house and build their investment team for direct deal sourcing. I know you guys have that at your firm. Can you maybe share some thoughts, around potential benefits and maybe pitfall for any families that looking to embark on that insourcing?
Yeah, I mean, we've talked about this quite a bit. I think the tough thing about trying to bring it all in-house, which we don't do, by the way, we do a lot of it in-house, but there's too many markets, there's too many things that you can't cover them all, right? So, and I'll give you some examples, like space economy. I know nothing about. We're investing in a company that's got rocket fuel. They're changing the way that rocket fuel propulsion is going to be. They're basically going to make it cheaper. But I don't know anything about that market, and so we have a a fund that we invest in that is sort of like our extension of our family office. But I think that the tough thing is for anybody who's trying to set up an in-house team is like, there's it takes a lot of expertise. It takes a lot of funding. It takes a lot of money to get people to go from working in a private equity or VC shop to, hey, come join the family office, be a generalist, and like try to figure it out, right? And so I think from our perspective, we try not to be all things to all people. We try to have like a really shallow understanding of a lot of things, and then allow a lot of our experts and even some of our families who are almost exclusively first generation wealth to really guide us on some of the things that we are not smart about and that we aren't experts in, and also just stay away from those things, right? So I think to answer your question pretty simply, like it's a process to try to get things done in house, and I think the best way to do it is like we did in VC is we started direct investing, realized we didn't have any expertise, invested in funds, and then added headcount over time to then help us with our direct investment platform. Mm-hmm. So I hope that answers your question.
Yep, absolutely. All right. Well, I have a number of questions I want to ask Simon, but he's not here, so I'm going to have to think up of something. But one of the things that over the years,
we're running short on time. We have a couple of minutes left.
Okay, perfect. Yeah. So we good with that then. Maybe just a couple of questions on, in terms of the non-investment I guess matrix that some of the families member maybe start to asking whether it's ESG, climate change, social justice, or whatnot. Pat and Manpreet, you guys represent multi-families and other family members. What are you hearing, and what have they talked about? What are some of the issues they bring up other than investment return?
Yeah, ESG is a big like green ESG consumption, like all those things are really important to especially the earlier generation families and people who are more sort of in tune with what's going on. Like we put a big investment into Impossible Foods, and part of our conversation was around, they are, it's a greener way and it's a more, economic way to consume meat, and it's a healthier way to consume meat. And so like trying to push that at the same time as a company who I think is sort of changing the world and the way that we see things is important to us, right? So those types of things are like sort of what we like to lead with, rather than the vice versa. And diversity and inclusion is also a very important aspect. Our CEO managing principal is originally from Mexico, so he and our parents are originally from Mexico, and so it's something that's very, very dear to his heart.
Yeah. Manpreet, from your thoughts?
Yeah, we're actually doing a lot of the same. We're trying to back minority and women-owned kind of management firms. So we've tried to do a lot of that. So that's been, I think, a little bit different. We're also investors in Impossible Foods, so we've kind of looked at a lot of stuff in that space. I think the other things people, I think they care about reporting, right? So I think the way you report is, I think people care about, and doing more video versus in person, because Zoom, I think partly because of that, and sharing information, how they can be helpful with the investments. I think is also big. I think they care about impacting the company if they can, right? So I think that's been different versus when you have traditional institutional investors who are pension plans and just for the return, right, more than anything else.